Good afternoon and welcome everyone to this presentation in the Legacy Project series. We're going to have an interesting conversation this afternoon. I'm Vanessa Knega. I'm the President and Director of Content Development with Interactive Legal. I have the pleasure of serving as your moderator in today's discussion. I think to get us started, I'm going to turn the floor over to Chad Reyes, who's going to give us just a brief introduction, and then we'll come back and get started with our conversation.
Great, thank you, Vanessa. Good afternoon, everyone. Excited to be with you today. Today we have a great discussion where we're going to merge the technical and the purposeful in planning a legacy. As always, with the Legacy Project, there's three things that we're always looking to do. We're looking to build community. That's 3 C's: community, conversation, and collaboration. So today's part of that conversation series, as Vanessa had mentioned. We're going to have a discussion today. We really want to encourage you to be involved. Open up your mic, talk, let's share. I believe that we all grow and develop more and able to serve our clients better when we're in a conversation rather than a lecture or a presentation. So just excited to be with you guys. And I don't know, I think this is maybe our 6th, 7th, 8th one. You can go on our YouTube channel and get all the previous recordings, as well as this one will be up there within 24 hours. But I just wanted to welcome you to the Legacy Project. Dan, my co-founder, Dan Scott, is on here also. So Dan, I'm not sure if you want to share something, but we're just excited to have you with us, and we're gonna have some fun tonight or today.
All right, Dan, did you have any opening words before we jump right in?
I think Chad covered it beautifully.
Okay, he usually does. Well, thanks for that introduction, Chad, to kick us off. And we'll go ahead and get started. I'm joined today by Chad and Dan Scott, who are the co-founders of the Legacy Project. And we are very pleased to have with us Richard Harris as well. Richard, welcome. Thank you for joining us.
Thank you.
So we're going to kick off this discussion. Today's topic is the convergence of the technical and the purposeful. And I think I can maybe give a little bit of background here because I've had discussions with these guys before, and I kind of know where this came from, that, the focus of this series is really focusing on legacy planning and planning with that purpose, talking to your clients, addressing what really motivates them in terms of their estate plan, and focusing on the human side of it. As I've heard Dan say many times, often people call it I think the soft aspects of estate planning, but as he always says, those are actually the hard aspects. And so that's really been the focus, to get us out of that mindset of very tax-driven, technical expertise and all of the techniques that a lot of us in the estate planning industry use for high net worth clients, and get us more focused on what actually matters to the client, what matters to them, and what should actually drive estate planning. So that's been the focus of this series, but at the same time, we do have to be very aware of those technical aspects of it, the prevalent techniques that we're using to transfer wealth in an efficient manner. So today we're talking about how those two things converge. And I want to get started with Richard because in preparing for this, it was brought to my attention this article, Richard, that you had written it was originally published in the 2009 December edition of Estate Planning, called "Split Dollar Loan to a Grantor Irrevocable Life Insurance Trust." And this is an example, I think, of a somewhat technical aspect of estate planning, a technical technique, for lack of a better term. And so I thought maybe we could lead off by having you kind of walk us through that technique, because I think it's a really interesting approach. And then we can kind of dissect it and see how it fits into this broader project. So if you could kind of walk us through the split dollar life insurance trust technique that you laid out in that article.
Thank you. Just to start out, anything that we do, really, if doesn't work for the client, it doesn't matter how good it is. And so what I'd like to do is get to what's in it for the client that might make it worthwhile. One, this is a technique that allows you to do transactions without making any taxable gifts. There's no GST and there's no estate taxes involved in doing this. Two, the technique is covered by regulations, and the technique follows exactly what the regulations say. So this is not cutting edge, bleeding edge type thing. It's something that is there in writing in the regulations, and this is just following the recipe that's there. Among the things that this does that makes it unusual, there are other transactions that are prevalent in the estate planning toolbox, mainly grats and sales to grantor trusts. Just for compare and contrast, a grat requires annuity payments. They can be stepped up, but it requires somebody make annuity payments, and at the end of whatever the term is, whatever is left over and above what was needed to pay the annuity is left to the beneficiaries of the grat. You can't have a grat go directly to a generation skipping trust. It's valued at its full value for GST purposes at the other end, rather than the 0 or very low value for gift tax purposes when it's going down just one generation. Also, at death, most, if not all, of the value of the assets is going to be included in the individual's estate if they don't outlive the grat. Now, that's a statutory technique and very well worth using in many, many circumstances. Another technique is the sale to the grantor trust. And here, it's not a statutory technique. It is covered, in my opinion, most of it is covered by Section 7872, which covers related party loans, and that should be the beginning and end of it. But apparently with the IRS, it's not. Because there is no specific regulations or code sections, the IRS will, if they feel that the transaction is egregious, will challenge the validity of the transaction in its entirety. And what they will say is it's a disguised gift. Now, we've seen cases, most recently, I think it's the Moore case, bad facts make bad results, and the Moore case was bad fact case. But it shows that the IRS is minding the store. Now, in the attorney's toolbox, the attorneys have various things that give them some comfort in doing the transaction, even though there isn't anything specifically on point to the things that do make them comfortable. As a matter of fact, Jerry Hesh has written a couple of articles, one in BNA, about the 10% myth. Basically, attorneys very often will feel comfortable if a trust either has 10% of the value of the asset that's going in, or somebody puts 10% of the value of the asset going in, makes a gift to, in effect, make it look like a business transaction. You know, I find fault with this because Section 7872 specifically was about transactions that were not business transactions, that were related party transactions. Some people will use guarantees, but the point in fact is the way that it's usually done is if it's not an installment sale where the note is being paid off in installments, then usually it's a balloon note with interest being paid. And the interest is being paid over a term that can be reasonably justified based on the life expectancy of the individual. So in effect, even though I'm an older person, I can get a 30-year loan that I'm sure, a 30-year mortgage that I won't outlive, and that's, a bank will do that for me. However, the IRS will frown upon a note with a 30-year term where I'm giving a note to somebody for 30 years, and that's the term of the note. So usually what practitioners will look at is reasonable life expectancy, and there are other hallmarks there. But that's one of the other constrictions. Sometimes they'll say that they'll get guarantees from the beneficiaries of the trust. And that's in cases where the beneficiaries have sufficient assets to do that. Again, I don't know that it's necessary, but those are the rules, the way the attorneys play it. And that's where you're left with. Now, when the IRS in 2001 and 2002 looked at split dollar transactions, basically a split dollar transaction is a transaction where two parties are involved in the purchase of a life insurance policy. One party is the funder, and the other party gets to name the beneficiary in very simple terms. And what happened prior to then is that in the absence of regulations or anything else, the insurance industry and the legal industry banded together and came up with what's called equity split dollar. Basically, that's where the individual only gets back the amount of money that they advanced towards a policy. So if you take an insurance policy that's going to build a lot of cash value, and the funder is only going to get back the premiums they pay, in all likelihood, there's going to be more money in that policy than the money that was advanced by the party making the arrangement. Now, I use advanced advisedly. It's a term of art in split dollar, and advance does not mean a loan. In split dollar, the old split dollar, normally the value of what the beneficiary, the person that named the beneficiary, received was in effect rent. I own a house and I let you live in it. What's the value of what I give you? It's the rent that I could otherwise get on the house. Well, in this case, the IRS said, well, hey, let's look at 1-year term insurance because that's like rent. And each year, based on your age, this is going to be the amount that we're going to say is the imputed value of the benefit. And the insurance industry also took advantage. They started publishing term rates that were strictly published. They were never sold, and they were very, very low, so that the amount of the gift would be very low. Well, all of this conversion, the IRS had tried one trick to try to get rid of the equity split dollar, and it didn't work. So in 2001, they came out with a notice. They came out with another notice, follow-up notice in 2002, and then final regulations in 2003. And here's what they said. For our purposes, an individual can pay directly or indirectly all or any of the premiums on a life insurance policy. So somebody's purchasing insurance, and let's say the premium is going to be $500,000 a year, and I want to make sure there's enough money in there to be able to cover the whole $500,000. So I'm going to put in $20,500,000, assuming that I'm going to get a 5% return. Now, this can be done as a loan. And here's where you get into the unique features of the regulations under 7872 for loans for life insurance that are different than 7872 itself.
Richard, before you just share, I just want to share something because I think it's important that many of the advisors, and listen, I've been in the advanced planning space for many years, and working with accountants and attorneys and wealth managers and stuff. And the traditional strategies are the idiots and the grats and stuff like that. And I think what was so key was when we got together, we were at your country club, and you were sharing with me that about the loans and the accruing the interest and all of that. And I just think that the people that are on the calls on today's call that are working in that space with idiots and grats, really this next part that you're going to share, I think is so valuable because there's an element of it which you just can't do with those other types of transactions, which is so important for really a legacy of a person building their legacy and ultimately transferring that legacy. And I wanted to point that out because I've been in this space for 18 years, and for me it wasn't natural, and you were able to piece things together that I just didn't see, and that's why I thought it was so valuable to get us on here today.
Well, Chad, after that buildup, I hope I come through. In any event, here are the things, and ultimately I'm going to double back to the GRAT and the sale to the grantor trust, which is where I started. So please hold on. One, in the regulations, it says, even if the loan is non-recourse, you can guarantee that the IRS will respect it as a loan if you make a representation, if the lender and the borrower make a representation that it is the intent that the loan will be repaid. Nothing about the interest, just that the loan will be repaid. And if you make that representation and it's filed with the income tax returns of the lender and the borrower, then the IRS is bound to treat it as a loan. Now, that isn't exactly what it says. What it says is the first filer, it has to be filed with the earliest filer of the tax return. So I say, well, let's do both. However, sometimes you're dealing with trusts and they're not a taxpayer. Well, here, you don't have to worry about that because if the lender files the notice, then that trust is covered, since you only need one party to file the notice in order to achieve this. The second thing that's unusual, and this is specifically in the regulations, is that you can accrue interest. And what that means is, in our COVID-induced low interest rate environment, you can accrue interest at a very, very low rate. Right now, you're talking about basis points on the short term and the midterm rate, and the long term rate in September is only 1.00%. Finally, you can make a loan for the life of the individual. So I'm making a loan, let's say I'm a 55-year-old person, and I'm making a loan to a trust that's buying insurance on my life, and the loan is going to be payable at my death. That is covered in the regulations. You can specifically do that. You can't do that with any other kind of related party loan. Now, how do you determine what the interest rate is? Well, the IRS says you use life expectancy tables that they use to determine life expectancy under annuities, tables under 1.72-9. And basically what it says is if somebody is under the age of 80 and they do a loan for life, their life expectancy is going to be 9 years or longer. And therefore, it's going to be at the long-term rate. If the life expectancy is less than 9 years, it's going to be either at the midterm or short-term rate. Now, let's get back to that lump sum loan that we made. We made one loan, and we made it for the life of the insured. So once we made the loan, will that interest rate ever change? No. It's locked in for the life of the loan. So in effect, even at the long-term rate, you can lock in a loan at 1% for the life of the individual, and it's all covered by regulations. You can accrue interest, and if it's a grantor trust, under the OID rules and the grantor trust rules, there is no income tax consequence to the grantor. So you've made a loan, not a gift. The IRS has to respect it as a loan. The loan can be the life of the insured, and the interest can be accrued. Those are all the very, very, very important features. There's one last feature that's also important. The security for the loan can either be the death benefit, the cash value, or both. So in effect, for those of you that are familiar with guaranteed universal life policies, if you're doing a transaction with a guaranteed universal life policy, at some point, that cash value, whatever cash value is there, is going to disappear. If you have it secured by the death benefit, that doesn't matter. So that's all you need in order to be able to do this. Now, let's go back to the example that I started with, where we have a policy where the premium is going to be $500,000 a year, and the individual is going to loan $20 million. Now, $20,500,000. Pay $500,000. What are you going to do with the other $20 million? Put it in a money market account? No. No, you're going to invest it. Now, let's go back to the GRAT and the sale to the grantor trust to bring it full circle. In those cases, you're generally using a business interest that is set up so that there's not lack of marketability and lack of control. And just for argument's sake, let's say that we have a $15 million business interest, and our appraiser says we can get a 33.33% discount. And let's say the cash flow that that business interest is producing is 4%. So we now have $600,000 a year of cash flow. We take the $10 million that we have to invest, and we buy that business interest. And we use the future cash flow to pay the premiums on the insurance. Okay, now let's compare the results of the techniques. One, are any payments necessary during the term of the loan? No. In a GRAT, you must make annuity payments. Most attorneys will have you pay at least interest. Here, no payments are necessary. Two, you do not have to receive back. You receive back just the loan plus the accrued interest. In a GRAT, basically, you're going to receive back using a 1%, a 40 basis point interest rate. Basically, in a 2-year GRAT and $20 million, you're going to receive back $20,600,000 or something. So you're going to receive back 2 payments of $10,300,000 roughly. An installment sale, you're going to receive the interest, and let's say you do it at the long term, so you're going to receive 1% a year interest on the 20 million. So you're going to be receiving $200,000 a year in interest, and at the end, you're going to receive the $20 million. In the GRAT, if the individual dies, whoops, and the GRAT's still in force, it's in the estate. I worked with a client that was worth a couple of $2 billion, and a very good attorney had set up laddered GRATs. Unfortunately, the guy developed brain cancer and died, and only the first GRAT was successful.
Wow.
So you had all of these other GRATs worth over $1 billion that wound up back in his estate. There is a question going forward, and my crystal ball is as cloudy as anybody else's, but depending on the administration, GRAT terms may change. They may have to be, at least their minimum term may be 5 years or 10 years. There may be a minimum remainder interest, so you can't do a zeroed out GRAT. So you have that potentially to contend with. With the sale to the grantor trust, your problem is that the IRS comes in and says, whoops, we're going to audit this. We don't know if this is a valid transaction. So what very often will happen, and I've seen this happen with so-called intergenerational split dollar arrangements, is the IRS will start horse trading. And they'll say, okay, you have all these things that you've done that are still out there, and we think this, and this are still, we have questions about the validity of those. If you give us something over here, we'll make the other issues go away. Now, with this transaction, the IRS doesn't have a leg to stand on. You followed the record.
Richard, I'm sorry, could I interrupt you for a moment? Because I think I want to, I'm kind of trying to be the audience surrogate here, and I just want to, I think this is my fault because I didn't really set this up very well. I just want to make sure that I kind of understand where we're going, and if I could summarize this and then maybe have you weigh in or others weigh in and see if I have this right, and this may be, our audience may be our advanced and they may not need to know this, but I think the idea is with the GRAT and the installment sale to the grantor trust, the goal, what you're trying to do is you're sort of trying to use the arbitrage between the interest rate, the low interest rate, and the actual gains, the actual appreciation on the asset, to transfer that appreciation over time, gift tax free, essentially, right? But the GRAT has the issues that you mentioned with the ETIP period. You can't allocate GST until the end of the GRAT period, when hopefully you have all that appreciation in there. So you're using more GST. You run the risk of the grantor dying during the GRAT term. With the loan to the ILET, you have to have the seed capital. You run the risk of the IRS coming in and auditing and looking at the loan transaction and whether it's actually market. Or whether there was a partial gift. And so I think what you're going to tell us about is how you've nicely laid out all the aspects of the split dollar rules. I think you're going to tell us how you can achieve that same shift in gift tax-free shift in appreciation with the split dollar transaction. and not have those risks that you have with the GRAT or the loan to the eyelid. Is that a fair summary?
Correct. Thank you very much.
Oh, thank you.
No, I appreciate any interruption for clarification because I'm speaking and I'm not getting any feedback. So,
Well, and speaking of feedback, I should have said this at first too. If our audience has any questions, they're free to type those in the question panel, and we'll call those out in a little bit so that we can get some more engagement here in this discussion. But please go ahead and tell us, because we're all interested to know more about how this technique works.
all right. Now, first of all, I want to say that the premise of this transaction is that life insurance is going to make sense as part of somebody's estate plan. That's the basic premise. Life insurance, for a lot of reasons, is a very good asset. Even not for estate planning purposes, it's an uncorrelated asset, which means that, for example, let's say you had a bond portfolio and it's gone in, and look at what's happened to interest rates. Look at what's happened to the value of a bond portfolio. If you die and cash is needed in liquidating the bond portfolio, you're not getting 100 cents on the dollar. Here, the life insurance proceeds come in with the liquidity, and it doesn't matter when you die, it's going to pay 100 cents on the dollar. So life insurance has an advantage, and I know very sophisticated asset managers are starting to look at life insurance as part of an investment asset portfolio because of its non-correlation and the fact that it brings down the risk of the other assets in the portfolio. That being said, I often come across people that are either making gifts to an insurance trust and may have a GRAT or borrowing money and having a GRAT go into with the trust as the remainder beneficiary to pay off whatever is outstanding, or they're doing a sale to a grantor trust and then they're using the excess cash flow over and above the interest that they're getting to pay insurance premiums. Now, in either of those cases, I think this transaction is far superior.
Richard, I have a question for you. So regarding where we are right now, right, with the elections that are coming up, right, with the exemptions and where it's at, right, and things are probably going to change. I'm pretty confident no matter who gets elected, we're going to see some changes happening, right? How does that impact, like how does that strategy and all, how does that impact our clients' legacies? And Dan, I know you've got a ton of experience in this space too. So I think I'd love to, once Richard shares, I'd love to us have that conversation, because I think that what I'm seeing is a lot of clients are unsure because of the future and what do I do and how do I handle it? Even just a client, a couple of clients that we've been speaking with, Richard, you and I. So I'd love to, tie that in as well, if we could.
All right. Well, first of all, I would say that I would be looking to use the maximum lifetime exemption before the end of the year. I think to the extent that somebody is in a position to do that, they should consider it. For business assets where people don't want to give up control, they can do it without giving up control by either setting up voting and non-voting interests or managing and limited partnership interests in LLCs so that they maintain the control over the asset and they don't give it up, but they're getting the potential appreciation out of their estate, and they're getting the asset, a good part of the asset out of their estate. So I would say, regardless of what you're looking at, I think that's something that makes a tremendous amount of sense. And because the year is coming to a close, and if you're considering this and you're considering it with business interests, you're going to need appraisals and you're going to need attorneys to do this. I know just about every trust and estate attorney that I've talked to is very, very busy already and only expects to get busier. So I would say get started now, and then decide later if you want to pull the trigger. You don't have
Well,
to.
I have that. Yeah, that's actually a question that I had, and I'm wondering if maybe Dan could probably speak to this, because Dan, I know you have a focus on legacy planning, but you represent some very high net worth clients, and I'm sure you're focused on end of year planning as usual, but even more so in this current environment, with it being an election year and the economy being what it is. You know, we're talking about these techniques for transferring wealth, and for you, as Richard pointed out, for using the exemption amount right now, because everybody's afraid that it's going to go away. So you want to get that gift tax exemption locked in. How do you, but we know, as Richard was just alluding to, you've got to motivate clients to get in the door to do these things, and you want them to do it now rather than December 21st, you know, so that you actually have a shot of getting it done. If you have this focus on legacy planning, and I think, and purpose-driven planning, and I think that we all agree that's because that's what the client is focused on. That's what motivates the client. How do you use that to motivate the client to do these types of very technical planning when that's really what needs to be done? I'm just wondering if you or Chad have any thoughts on that, of how you get the client motivated to pull that trigger, you know, on this type of very technical planning.
I have to start by saying I take a very different approach. To me, you know, and let's talk about life insurance. I think we need to make a distinction between financial assets and legacy assets. And legacy assets are those that represent the human story, the human purpose, etc. Those are assets that are reflective of that. The challenge and the bridge is that when we talk about things like purpose and legacy, in order to actually make those something that can last from a legal perspective, right, both during your life and after, you essentially need to infuse purpose and legacy into financial assets. So, right, because when I say financial assets, I mean, you know, anything that's you know, whether that's a company or things like that, right? So for life insurance, for example, life insurance I've always seen is really serving one of two very general purposes. One is liquidity, and liquidity in the sense that on death, there is the need to essentially preserve another asset, right? Because you don't want to sell it or compromise it through, you know, loans and things like that, leverage it. That's one option, and the other is, you know, life insurance in the sense of you know, a gift, right, of funds that maybe a family otherwise would not have. In the first instance, liquidity, you're really using the financial, you know, the financial aspect of the life insurance to preserve a legacy asset. In the second example, it is the proceeds of the life insurance that have the potential of becoming a legacy asset, depending on how you own those proceeds, right? So translate that very simply into whether or not that's owned through a trust, and there's certain terms and things through which you can infuse purpose. So back to your question around technical, and I do want to kind of take issue with the word technical, because I think everything that we're discussing today certainly is technical, but it's technical as it relates to financial assets. So it's technical in the sense of tax technicalities and things like that. one of the reasons that I am a part and help create the Legacy Project is because I think we need to have an understanding that the human components, the non-financial aspects of planning, are equally as technical. And we need to bolster and focus on our skills as technical drafters and advisors on techniques and strategies that speak to not just the financial assets, but to the human and other less tangible. So all that said, to your question about, when it comes to things like exemption, I mean, this is where I'm a lot more relaxed than other people about the urgency to capture a tax credit or things like that, because if you don't know, a lot of these structures end up becoming, or have to be irrevocable. And so I don't want to put anything in place that you don't understand why you're doing it. And so for me, it always starts with why. Once you have that, now you can build tax efficiencies into your plan. But I think too often we sort of panic about things like, oh, the exemption and having to pay an estate tax. I would rather pay an estate tax for a plan that accomplishes, from a legacy perspective, a client's objectives, than not pay a tax and have no legacy planning involved. And so that's the whole issue around the tax cart before the horse. And where I think as planners we become too focused on you have to preserve the financial asset. You don't have to preserve the financial asset.
That's a pretty radical view, I have to say, for estate planners. I think that's pretty radical.
Right. Well, legacy assets in a sense, right? So this comes back to, just like money for money's sake doesn't work. I think that's the reason that wealth is made and lost in 3 generations. It's because traditional estate planning has gone in a direction where it is purposeless from that human element and too focused on just the preservation of money for money's sake. And without direction, money is dangerous and money leads to turmoil. So before we get to preserving assets, which is all tax planning is just the preservation of that nest of financial assets. If we don't turn financial assets into legacy assets, or we don't use financial assets to preserve legacy assets, we're doomed. And so I don't discuss year-end rushed planning around financial assets unless I have a strategy in place and an understanding around the importance of how we're using financial assets or how we're transforming financial assets into legacy assets.
Yeah. So
I don't know if that answers your question or a dodge, but I just, it's not an urgency. I mean, I wrote an article, a few years back when I was writing at Forbes, and the whole point was why the wealthy shouldn't care about estate taxes, right? We're so ingrained that we have to care about estate taxes. Estate taxes, really aren't the point, right? That's again, it's just preserving a financial asset. The point is really getting them to focus on purpose and legacy first, and then figuring out, okay, how do we preserve the legacy assets? Because the reality is you can have $100 million estate, 50 million of which are really purposeful legacy assets. So the 50 million it's not can be used to upkeep the legacy, those sorts of things. But you have to make that distinction and understand that first. So something like life insurance, you have to define it first. You have to define its purpose. You have to define its use. You have to define its structure depending on that purpose and use, and why you're doing it. And in terms of the lifetime exemption, whether you're, if you made your plan yesterday, then you were dealing with yesterday's facts and circumstances, right? And if you're not quick and you plan in February of 2021, well, then we'll plan around whatever the tax hurdles are at that point. But I don't want to create panic around that, because it's more important to me to get the client to understand that taxes don't matter without a strategy and a legacy plan first.
So,
right. Well, and like I said, I think that's a pretty radical view, but maybe, I think that's the point of this, is maybe it shouldn't be. So
state, Vanessa. So, I'm in Connecticut, a little bit of that going on.
Vanessa,
That's
can
right.
I,
That's
can
right.
I
Well,
answer
yeah,
this?
you've got that. Yeah, Chad. Let me let you, and maybe you will address this too. But I mean, I'm curious if all of you could address this. I understand what Dan is saying, and I completely support it. But at the same time, all of us as advisors have an obligation to our clients to convey some urgency when we think it might matter to them. So I'm curious as to, that would be kind of my rebuttal, is
Yeah.
how do you do that?
Can I address that
But I want to.
The urgency, and I've heard
Chad,
this,
would you cede the floor to Dan?
lawyers are always worried about liability, right? And I do have to make it clear, like at Spotlight, I've sort of moved away from the practice of law, right? So I'm more focused on the human planning anyway at this point. But when I was in law firms and law firm settings, we were constantly worried about, notifying clients of changes of laws and liabilities and the obligations and the duties around that. What about the obligation to basically explain to clients that traditional estate planning statistically fails, right? That there's a 70% chance a traditional estate plan is going to result in your wealth being lost by the third generation. We don't talk about that. We don't talk about, so there's a lot, again, this is where there needs to be a shift, I think an industry shift, to focus on how we actually solve that problem. And the answer, to overly simplify it, is to give financial assets purpose and direction, because then there's a path forward. And until we start talking about that duty and that obligation, how do I, if I have an obligation to tell you that you're going to lose 50% of your estate because of a tax law, why do I not have an obligation to say, even though I just saved you 50% of taxes, you have a 70% chance that your estate's going to be lost statistically, right? That to me is much.
Dan, the question is, all right, you're the attorney. What skill set do you have to be able to address that?
Richard, can I have to jump in because I'm listening to both sides, and I value both of your opinions tremendously. And
Answer that, Richard.
I'm a big
I'll
believer
answer
of
your
this.
question.
Hold on one thing. Let's address that after. I'm a big believer that we replace the word "or" with "and." That's the first part. I think that the word "or" is very limiting. And when you use the word "or," you create divisiveness in whatever you're trying to accomplish. So, Vanessa, to answer your question, I have these cards that are in front of me. I'll show. It says defining my wealth in terms of broader than financial capital alone, right? And then another one says open two-way communication with my family and others I care about. And I'm just going through. It's a deck of 52, but it says factoring in the unique strengths, gifts, and passions of my family members when deciding to gift or transfer financial wealth to them, right? I'm just randomly picking up ones. My family having a great reputation in the community. So from a practicality standpoint, I lean towards technical and purposeful together, right? And I don't think one you could do without the other, but I want to share an example of a family that we're serving right now and how we're doing it, and I think it could maybe bring some light to those that are listening. I worked with the husband and wife, and we went through these cards. There's 52 of them, okay? And I asked each of them, I said, I want you to prioritize them in the top 10 values that are top 10 to you. And the husband, they were about 80% in the same, on the same brain wavelength and thoughts around 80% of them. 20% of them, they had their different perspectives, right? But one of the things that was interesting, and I'm going to tie it into the year-end planning. One of the things that was very, very interesting is the husband put that one of his values is little or no debt. Now he's amassed a good amount of money, but he wanted no debt. So my question to him was, and we were in this last meeting, and Enil, who handles a lot of the legacy project stuff, is on this call, so he was in that meeting. And my question was, if you want little debt or no debt, then how do we design your legacy plan, which we're using all the values and we're going to build that into his planning, but realizing that if you're choosing no debt and you don't do the planning, you're building debt for future generations. And part of your goal is to allow that next generation to be able to fulfill what they want to accomplish in their lifetime. And if the family has a large tax bill that needs to be paid, that automatically hinders your ability to fulfill your purpose, like Dan talks about. So my thing is I don't think we need to rush into something just to say we're going to do it. But I do think my obligation as the advisor in understanding the technical and the purposeful is to give them facts so that they can make decisions. And when we work with, most of our clients are entrepreneurs, and entrepreneurs want advisors that can give facts so they can make the decision. And all I said to this person was, this is the limit of the exemptions. This is how much you've used of it. This is how much you have the ability to use. And if we're able to create it in a way that we could transfer wealth out of your estate, if we can do things where you still have some control over the asset, meaning direction, but not necessarily legal ownership, right? And we're able to incorporate your purposeful side of it. Children being in the business, children living out their purpose and operating in their gifting and talents, right? Being able to have a great reputation in the community. If we're able to accomplish all of that and reduce your value of your estate pretty substantially, because we have these tools that are relevant now, it may not be there next year, may or may not, I can't guarantee. And I'll tell you what, the success of that meeting was so extremely high because I didn't give him the one or the other. It was an and. It was, we could do both. We can be some creative tax planning, and we can be intentional and purposeful, but we have a process that we use that helps them understand that. And part of it is giving this deck of cards to that family to take a half hour to go through and say, this is valuable to me, this is not valuable, this is not important to me, this is extremely important to me, and then coming up with their 10 core values and then building their plan around that. So I share that because I come on both sides. I used to be extremely technical, then I went to a very purposeful, and realizing that I believe success is the fusion of two.
Can I want to jump in just on one thing you said, and I don't think we disagree, but I'm going to disagree with the way it was said. You were talking about facts. Your job as an advisor is to show them the facts,
including that 70% that you mentioned.
Well, one of the problems that I have felt throughout my career, working with many other professionals, lawyers and others, is that I see an advisor's job as giving advice, right? Lawyers at some point have become overwhelmingly transactional in their view of clients and client relationships, whereas at one time we were counselors of law. And to counsel and to advise is to guide your client, because you do know best. That's why they're coming to you. And I think we have to shed the fear of being wrong sometimes and really try to help our clients make decisions about what is best for them. So, my job when I was a lawyer was not to tell you what the law was and for you to decide what's best for you. It's for me to know the law from an expertise perspective, or know how to find the law, more importantly, because the law is always changing. I was never impressed by people who can memorize code citations, and it's always changing. The value of a good advisor is application and analysis, right? So if you're coming from if you're a financial advisor, it's your knowledge of financial instruments and markets and all that stuff through the lens of advice. What's best for that client, which really comes back to happiness. What we're all in this for is making our clients happy, a sense of happiness and personal fulfillment. With it, which again leads back to, and I brought this up several times, that the positive psychology movement and studies around human happiness and senses of personal fulfillment, right? And that leads back to a sense of purpose. So as advisors, where I'm coming from is that collectively we need to commit to trying to help our clients be purposeful in their lives, to know that they can make a choice and that in fact they have to, because without it you're lost. Without it you're actually causing problems, particularly for your family. And then we need to come at that overlapped center of advisory, right? What is best for our client? We need to say that that's our job. And if you don't agree that purpose is what's best, well then fine, we can disagree on that, right? But then we bring our expertise, then we bring our technical to that middle point of intersection. And that's where I think for some reason we've all become lost. And that's,
Sure.
not only all, right? Present company, and there's plenty of great advisors on the calls and things, but as an industry or as industries, we've become focused on selling financial products. We've become, focused on selling documents that we draft. We've become focused on preserving the asset itself. We've become focused on, right? And we've stopped focusing, if we ever did, on the human and on what I say is like legacy is not financial legacy. Legacy, that word as I use it, is your life meaning. When someone says, Richard, what was your legacy? It's going to be the legacy in terms of the impact that you had on society, on culture, on your family, depending on how broad your reach was.
Yeah.
What did you mean?
I'd like to share something.
Richard, no, Chet, I
say-
wanted to come back to Richard because I know he had a point and I wanted to bring it back to you, Richard.
One thing, I understand what you're saying, and frankly, my method when dealing with clients is very much in line with what you're talking about. One, I get the greatest satisfaction from helping people,
Mhm.
whatever that entails, not just in business, but in every aspect of my life. That's where I get my greatest satisfaction. When I meet somebody for the first time, if I'm reviewing an insurance portfolio, the first thing I do is says, let's not look at that. Let's talk about what you're trying to accomplish. What are you looking for? When I meet
Right.
somebody for the first time where somebody's recommended me to talk to them about insurance, they'll invariably ask, well, Richard, why do I need insurance? And my answer is the same. I don't know. Let's talk. And I'm going to have a conversation basically about them, listening to them and hearing their history and what their concerns are, so I can see what value I can add to the individual situation. I also believe in collaboration. And I think, Dan, when you get into that area, and I think that's part of what this is about, the collaboration. When you get into that area, I think maybe the model is somewhat broken in terms of people willing to collaborate and bring in other professionals from other disciplines to work jointly on a situation rather than I'm the captain and you do what I tell you.
And I think that's an important point because I just want to say coming at it from the estate planning attorney perspective, and I have a unique perspective in that I deal with estate planning attorneys throughout the country and I hear what they're saying and what they're concerned about. I think there is a little bit of a bias, and I hope I'm not offending anyone. I'm sure I'm not telling you anything you don't know. There's a little bit of a bias against the insurance industry on the legal side in estate planning. And I think that this collaborative approach, and I love what you're saying, Richard, about somebody says, why do I need insurance? Your answer is, I don't know. I suspect it might even be in some cases, maybe you don't, but let's see that it's a good product it's a good fit for a lot of people. I think the more that people can take that collaborative approach of let's work together to find the purpose here and see how this product, this technique can fit within that purpose, I think will make the legal side of the estate planning industry more comfortable with those in other roles, whether it be on the insurance side or the advisory side. I think that's actually very necessary to get the legal side more comfortable with those other roles that can be very critical to fulfilling the client's purpose. I have a question, sort of based on Dan's comments, and I hate to bring it back to that liability sphere, but that's what we deal in, certainly as attorneys and anybody in this field. And it's something that I've not thought about before in terms of when we've had these conversations is, I think anybody on this call is likely to agree with you, Dan, right? That is critical, is finding the client's purpose, finding their legacy and what's important to them, and everything else is driven by that, right? You're not planning for that asset, you're planning for their legacy, and that planning for that asset is just part of that. And that's all well and good for mom and dad, right? But that future generation, what message do you convey, and how do you convey it to that future generation who comes to you and says, but mom and dad were in your office in October of 2020, right before the exemption dropped back down to $3 million, and they didn't do the planning they could have done then. And now we have this, now mom's dead and they're dead, and we have this huge estate tax bill. How do you cover yourself? I mean, is one way to look at it, but also how do you convey that important message to that next generation that, no, this was actually consistent with your parents' purpose. This was consistent with the plan. This was what they wanted to do. How do you document, or how do you convey that to that next generation? Chad, I'll turn it over to you. We haven't heard from you in a while.
Well, Dan, I think was that a specific question to Dan, or you wanted both of us?
Anybody who wants to weigh in.
So I take the role, and when I work with families, I take the role that I'm not their attorney, I'm not their accountant, and I am not their property and casualty advisor. I may have understanding, I may have more knowledge than some other people in that area, but I'm not in that capacity. However, I always premise this with saying is that when we're planning for what you want to accomplish and for what you value. I believe in value-based planning. Like we take the person's values, we understand what their values are, and then how do we take those values and make it part of their overall estate / legacy / generational plan, right? And I've walked away from clients who don't allow me to get into those conversations because I just don't feel comfortable with that. I don't feel comfortable when you look at a person's net worth and it's making $100 million for simplistic purposes, and you're dicing it up as if it's a pizza pie. Oh, we're going to take 24 million, take that off. We're going to transfer this with this and that. You know nothing about them. You know nothing about what values to them, what they value. You have nothing about their family dynamics. So I don't get involved in those types of relationships, and that just helps me protect my litigation because I don't put myself in conversations with clients that are so driven just for the dollar. My wife and I had a coach many years ago that said to us, Chad, your business model needs to attract or repel people. So our model just attracts people that want to do legacy planning and they want to make sure it's done tax efficient. So I don't find, to be honest with you, Vanessa, I don't find many clients that are coming in my door and I'm just chopping it up like a pizza pie with exemptions and all of that. Most of the time, it's a mixture of the two. I'm spending time knowing who they are. I'm spending time knowing what they value and what they're trying to accomplish, like Richard said. And then I'm putting my technical hat on and saying, how do we do that? And then I go to the softer side of it and say, well, I know 3 things. When I'm planning with families, I know 3 things. One, 90% of the wealth doesn't make it to the 3rd generation. 97% of the wealth doesn't make it to the 4th. And there's 3 reasons why: breakdown in communication, breakdown in trust, and lack of preparation for the next generation. So I take those 3 and I infuse that in our conversation with, we're transferring wealth, but how do we make sure we address these 3 issues so that we don't have generational problems? But I don't know if that answers it, but I tried my best.
Yeah, I'll chime in, I guess, a little bit on this. A few things. I mean, to Chad's point, you have to be able to identify what is potentially sort of a dangerous client, right? And so somebody that is, purely just money driven or things like that, like, you know, I tend to not take them either. I have been fortunate enough in whatever it's been, 20 years or so of practice, that I've never been sued. So I don't know the outcome if someone were to litigate against me. What I do have is a fierce confidence, right? That if you tried to argue that I was not acting in the best interest of a client, you're going to lose that argument. You know, everything that I do is very clearly with the best effort and intention for the client. And, you know, I dare you to argue otherwise. I guess I'm not afraid of that. And when you think about the legal threshold around, you know, what, professional negligence? No. You know what I mean? Like I know that I just know that I'm not negligent. I know that I'm not, you know, I just know. So I'm not afraid of that. I'm doing, you know, and if what I do differs from other practitioners, hey, there's a lot of different solutions to the same problem. And I have my approach, and I know that I am representing and communicating the best interests of the client. So I'll take on any greedy error that says otherwise. I'm not worried about it. And I think that, you know, lawyers in the legal industry in general, it's a, you know, it's an overwhelmingly sort of fear-based industry. I mean, even the way we sort of advise clients, right? So sort of always, you know, you're backing up against sort of the least likely outcome. And it's just not how I operate, but that's maybe a little more stylistically. But I think that lawyers and all advisors, if your intentions are really good and you're a hard-working, committed person, I think you should be pretty confident that you're not going to lose if somebody tries to bring a claim against you. I have faith in the system around that. You know, you have to operate with a little bit of, you know, faith in humanity in the system, that doing good, you know, you can't break that. You're not going to break me on that, you know? And so maybe that's just, you know, my perspective on life, but I'm not going to frustrate my personal existence because of a fear that somebody's going to falsely attack me or accuse me of something. And maybe, you know, having gone through a divorce, I've been accused of many things, you know, so I'm not afraid of being accused of things. You know, I know, you know, you gotta know how to fight it. So.
Right. Well, I think that's very well said. And I think to Chad's point too, it sounds like you're baking that intergenerational communication into the plan, and that's part of this plan, this type of planning as well. I know we probably need to start wrapping things up. We did have a question from Arthur from Connecticut, and it related to the split dollar technique. And he just said that, you know, there was a little bit of confusion and wanted to know how what was being proposed was different from just a sale to a grantor trust. I think what we should probably do is refer people, Richard, to your article, because I think there's so much good information in there. And so, as I mentioned before, it's split dollar loan to a grantor revocable life insurance trust from the December 2009 edition of Estate Planning Magazine. And I think, Chad, I think you send emails out. Are you planning to send the site to that article as well?
Yeah, Vanessa, I'll have our office send an article to Arthur regarding the, you know, that article, so he can read into it more.
Okay, yeah, that's perfect. That's great. Thank you. So I guess as we sort of wrap up, I just, you know, I would just ask if there's anything, any thoughts that any of you want to share to kind of wrap this up, to wrap up how we converge the technical and the purposeful, or any thoughts as we approach this end of year planning that, you know, that you think are critical for people to keep in mind as they talk to clients about end of year planning. So Richard, let's start with you.
Well, I think that you need to have a conversation with your clients about the situation and find out what their goals are and whether end of year planning makes sense for them or not. I think you have to let them know what your thoughts are about end of year planning, what potentially is at stake, what they have to lose, and let them decide whether they want to pursue it or not, and have a more meaningful conversation about what end of year planning can do for them in terms of their legacy.
Yeah.
Very well said. Chad, Dan, I'll let either of you go
You want to jump in?
next, and we can kind of wrap it up.
Yeah, I want to touch on something Vanessa brought up. You know, I mean, she kind of pointed the finger at the insurance agency, insurance industry for sort of a reputation.
There was no finger pointing. No finger pointing.
Yeah,
Well, hold on a second. I do expert witness work.
And there should be a finger pointed.
It wasn't an accusation, but it was just drawing on
there are bad actors out there, and there's a lot of enticement for bad actors in terms of trying to generate large commissions and the things they'll do for that. There are also situations where I've come across lately where I've been involved in suits against trustees of insurance trusts for what they did or didn't do, which is very interesting.
Yeah, it's a fair point. There's bad actors in every aspect. Dan, what was your
point, Richard? Right? I mean, the same is true of certain lawyers who want to bring up billable hours. What my point I was going to make was, every industry is potentially, guilty of that. And the two of you are both involved in insurance, or two of the most genuine, thoughtful people. And so, I think it comes back to, advisors. We're not salespeople. And I think that's part of the issue too. And you can almost, the good advisors, whether it's an insurance advisor or a financial advisor or a lawyer, right? I'm not selling you time. I'm not selling you a product. I'm not selling you, right? I'm offering solutions. And, it almost makes you kind of come back and, to that point about purpose, right? Is you have to, if all you're doing is trying to sell something to make money, what's your purpose? Maybe you need to do some soul searching yourself. Because your own happiness is at stake. So I just wanted to throw that in there to say that everyone in every industry, there's a noble cause and a noble opportunity to serve clients well. And I didn't want to make it sound like we were suggesting that everyone in insurance or in any industry is in it sort of for the wrong reasons. And that's again part of why we're doing this, is to build a community of people wanting to do the right thing for the right reasons. And we're, it's an uphill battle, but let's do it together.
Well, I just
thank you very much for making that point, because that was my point as well. That
you weren't going to sleep tonight.
Right, I know. I'm a little bit concerned now, but no, just that I think this is the type of conversation that can bring out exactly your point, that there's there are people in every aspect of the industry who want to do what's right for their clients. And I think that's what's important about this, is it helps to point that out.
Well, I'll add one thing. I don't know any other advisors I've met, but I don't know currently any other advisors who are just salespeople. You know why? I won't know them. Right? And so every life insurance person I know, every other attorney that I associate, everybody, you better not just be a salesperson. I'll meet you, but I won't know you. And so that's an important thing, is surrounding yourself with good people.
Yeah. I'll end it and say this, Vanessa, is that one, I agree that the life insurance industry it's a broken industry, and there's many reasons for it. But I will share this, and I was on a call earlier. I was doing a mentoring call with younger advisors in the insurance business, and I was just sharing with them from my heart about the industry and what struggles I went through and how I developed and grew. But I'll share this, is that the life insurance industry, and for this matter, the estate planning industry, the wealth management industry, but I'm speaking specifically the life insurance because that's the one I know the best. It's an act of love. It's an industry that's based on an act of love, a love for others, love for your family, love for your business, love for those that come after you, right? And the industry started, and I'm going to tie this all into the Legacy Project. The industry started with life insurance being designed for the Presbyterian Synod of Philadelphia, because they had lost This is in the 1700s in the United States. That was the first life insurance corporation, and they had, you know, they were losing, they had lost some clergy, and they needed to make sure that they were being able to have funds available to bury them, right? So that's how the industry started. It was an industry that was based on love. And when you think about what we do as advisors, if it's either based on fear or it's based on love, and if it's based on love, then it's love for yourself to do the right thing for those families. It's love because you know that they're doing stuff that they want to help their families, right? And at the end of the day, when we're doing these conversations, it's not to give different perspectives as much as it is to reveal intentions of the advisor. Part of the reason why I wanted to start this legacy project, and Dan wanted to, is to get people to realize the intentions that they have stuck in their heart, because we all have intentions, and what you know, out of the abundance of the heart, the mouth speaks. So when we as advisors are doing things unethically, it's because something has made it here that's now coming out there. So my point being is this, is that as advisors, I just want to give this encouraging word to wrap up. We should be doing things from a place of care, a place of love. And, you know, as I build our businesses, I have 20 nieces and nephews. 20, that's 2 baseball teams and 2 reserves just in case they get injured, right? And the way I look at this, and I say this to my wife all the time, I say, babe, every decision I make, I picture, because we don't have any children yet, I picture my nieces and nephews having to come into this business. And the last thing I ever want to hear is I want to hear one of my nieces and nephews that look up to me say, your uncle was a crook and he screwed my family. And because of that, I make that decision every time I make a decision. And I think as advisors, we need to make the right decisions, and we need to get out of our comfort zone, because sometimes I have to say, I'm sorry, but I can't serve you because you're asking me to do things that my future generation is going to have to answer to.
So you're planning for your legacy in doing what you
100%.
do.
In everything I do is about my future legacy and my wife's legacy, because one day I'm going to have 1 or 2 or 3 of my nieces and nephews come into our businesses. We own multiple businesses. And the last thing I want them to hear is your uncle was a guy who screwed me or screwed my nephew or my grandson.
That's a wonderful
I love
point, Chad. Thank you. Yeah, and to your point, Vanessa, everybody on this call and everybody listening, we should all be not just planning our legacy, but we should be living it. You know, you know, choose the life you live is the legacy you leave. That's you know, I think the message there. We can all choose it. Chad, that was beautiful. Thank you, sir.
Thank you, guys. And I just want to wrap up in saying the next one is October 22nd. So we're looking forward to you joining us. If you want the recording of this, it's going to be on our YouTube channel. But like I said, October 22nd at 12 p.m. will be the next legacy conversation. Thank you for spending time with us. I hope this was valuable. I hope it blessed you. And we'll see you on October 22nd. Be well.
Thanks, everyone.
Bye all.